Good afternoon, everyone, or good morning, depending on where you're joining us from, and welcome to our first webinar for 2023. We hope you had an enjoyable Christmas break and that you've come back refreshed for the new year. Today, we have Adrian Bailey presenting the webinar. Many of you would be familiar with Adrian, who is the principal of our Sydney office. And in today's webinar, Adrian will be taking you through some of the relevant tax and accounting issues, which are likely to be significant in the coming year. So just for those of you who haven't used our system before, the PowerPoint slides will be available for download. All you need to do is click on the Files tab, and there should be a link there for you to download the PowerPoint slides. But if you can't work it out, or if you forget to do so, don't worry, because they will be included in the feedback email, which will be coming out later today. And just on that feedback email, we would be really grateful if you could just take a couple of minutes of your time to complete the survey, because we do take into account all of your feedback and all of your recommendations, particularly for topics that you might be interested to hear about in the future. And so also, if you have any questions throughout the webinar, you're more than welcome to pop those in through the chat function. So there should be a little chat button where you can type in your question, and I'll be moderating those questions, and I'll interrupt Adrian at an appropriate time and put those questions to him. And we should also have plenty of time at the end of today's webinar if you have any questions that come up then. There will also be a few polls asked as part of today's webinar, and we'd be grateful for your participation in those polls. We're keen to get your opinions on the questions that are being asked. So that poll should just automatically pop up on your screen, and if you could just vote for the answer which you think is most appropriate, there should be no issues with that poll system. So I think I've covered off on everything that I need to tell you about. So without any further ado, I might hand over to Adrian to get started.
Thanks, Kate. I think the only thing you missed was that this will be recorded and it'll be available via our website and YouTube channel later today. And also, I guess, in terms of the polls, just so you know, your responses on the polls themselves are anonymous, so don't worry about being identified by what you put in. So as Kate mentioned, we're going to just touch on some things that we see as relevant for 2023 and really in the tax world, focusing on, I guess, the first half leading up to the end of the financial year and what we can expect to see both from the tax office and then also from the state revenues in each of the states. We're going to discuss that briefly and some things that they've been doing in that world in terms of payroll tax. What we're going to cover are really these 6 bullet points. So we're going to have a chat about where did Section 100A end up. So we had the finalisation of the draft ruling that came out last year. And then we've had a couple of cases that have been decided since then. One, both of them really after the ruling was finalised. Touch on Division 7A and whether anything is happening with there, the traditional bugbear of, when are things actually going to change. Have a chat about whether people are using companies or trusts for business structures and the positives and the negatives of each approach. Have a look at some trustee resolution issues, obviously going to be more relevant as you get into your tax planning season for your clients and considering your trustee resolutions and some of the issues that have arisen there recently, and in particular in relation to a recent decision called Aui's case. Resolution of the Bosnack case. If you've been to our presentations before, you would very likely have heard us track the history of Bosnack through. It's gone federal court, full federal court, and now we've had a decision of the High Court. It's important in terms of asset protection, and we're going to discuss that as well. And as I mentioned at the beginning, also discussing payroll tax, medical centres and other businesses. The reason why I've got medical centres there as the dot point is because they're in Queensland. There's been a recent release, I think from memory it was on the 22nd of December, so just before the Christmas closure, a recent release in relation to their views on when payroll tax applies to medical centres. Where did Section 100A end up? In last year, we had the release of the draft taxation ruling, which has now been finalised as 2022-4, and the practical compliance guideline, which has also been finalised as 2022-2. Probably went to a few webinars. I know we certainly hosted them, and they were very popular in terms of what the draft ruling meant in terms of Section 100A and what it meant for clients with trusts and the distribution strategies that you may or may not be using. So we've had that finalised now. Because of these two cases, B Blood, which is under appeal, and Guardian, which I haven't seen yet whether it is under appeal again to the High Court, or I should say whether a leave has been applied for to apply for special leave to appeal to the High Court. I would think that part of these rulings will need to be revised, and the PCG in light of B Blood and Commissioner of Taxation. Of course, without being too cynical, I would think the Commissioner would be reviewing that in line with B Blood, which was a win for him, as opposed to Guardian, which really was a loss in terms of Section 100A. And I'll touch on those cases and the decisions that came out. So taxation ruling 2022-4, as I said, has now been finalised. I consider it's been a significant watering down from the draft ruling in terms of what they consider to be ordinary family or commercial dealing. To a certain extent, I kind of wonder whether they watched some of our old YouTube presentations on Section 100A and what people have suggested to us via the LRC are ordinary family and commercial dealing, because when you read the new taxation ruling, you'll see quite a few examples that are very similar to those raised in our presentations. And I should say we can't take the credit for those examples. Most of those came from comments from our Legal Resource Club members in terms of the ways that they see things as ordinary family or commercial dealing. So we've had things like in the rule and the acceptance that it may be for cultural reasons that we're distributing to grandparents, for example, and retaining the funds, maybe to build up family wealth, maybe to build up money for a deposit for a home, all of those sorts of things, which were examples that we raised as things that people had said to us and that what they thought was ordinary family or commercial dealing. So I mentioned it will need revision following the release of B Blood and Guardian in terms of some of the commentary that they've got in there. But I would think in terms of Section 100A, it is still going to be a risk area and it's still going to be grey. And one of the things that didn't come from Guardian decision was any further judicial comment on ordinary commercial or family dealing. And I'll say why when I go through the presentation. So in terms of what's up with 100A, as I said, fairly significant watering down. There was a bit of the skies falling in sort of mentality from some presenters in relation to 100A with the draft taxation ruling. I was always of the view that if you could show what you were doing was in relation to ordinary family or commercial dealing in that you were either building wealth or, as I said, you had those cultural reasons, or you were looking to do something that was for the benefit of the family group, then I didn't really see an issue with Section 100A. Also got, in terms of the Guardian decision, the tax office really have some serious issues there in terms of what the court decided in relation to when things are an arrangement, because we need to have a reimbursement arrangement for Section 100A. So I'm not saying ignore it. It's always been a risk. It's been around, 40 years now, or 50 years, I should say. Has an unlimited amendment period. So with Section 100A, it's obviously something that we should keep in the back of our mind. And I think it's one of the examples where it will potentially be used by the tax office. Is not in your sort of ordinary mum and dad family group, but it's in a situation where B Blood, where we're doing something a little bit smart and a little bit clever and something that's within the legislation but will fall afoul of 100A. And I'll explain what I mean by that when I talk about B Blood. The PCG has also been finalised, so it's a series of examples. They've categorised into 3 colours. The tax office seems to love doing that these days, where they put things into white, green or red. White zone surely are things that are entered into before 1 July 2014. So they're saying they won't put compliance resources and consider 100A into those sorts of arrangements. Green zone is where you've done something, they think you're okay, so they won't necessarily ordinarily put compliance efforts into it if they identify that you've done it. In red zone, if they come across you and you're doing something in the red zone, then you can expect further review or audit. Like with most things in life, it's a guideline. So you may see, depending on the ATO officer you're dealing with, if you're having a desktop review or you're part of the next 5,000 review, you have clients in that, they may either follow the guideline or decide that they want to take a look into something that you thought was white or green. It really just depends on the ATO officer themselves. So I wouldn't put a lot of faith in the fact that you're in a green zone arrangement. I mentioned we had the decision of B Blood Enterprises and the Commissioner of Taxation, which is under appeal. So we may have a change in terms of the decision, we may not. And this was a Section 100A decision. So in essence, what we had in B Blood was a really clever tax scheme that clearly, reading through the judgment, the firm involved in implementing it, and wasn't Cleary Hall, we're not that clever. The firm involved in implementing it had done it for a number of clients, clearly. And in essence, what it related to was that we had a discretionary trust entering into a share buyback. So we had, and when I say discretionary trust, it was the shareholder of a company. The company has entered into a share buyback where it buys back the shares in itself. What we have then from a tax purpose or a tax result is a deemed dividend, and it's a franked dividend. So in this case, it was a deemed $10 million franked dividend. $10 million in cash goes into the trust, but we also have a deemed dividend there under the buyback. We also have a deemed dividend there for tax purposes. The trust appointed all of its trust income to a corporate beneficiary, or the trustee did, I should say, more precisely, of which there was $300,000 of ordinary income. And so because the ordinary income flowed, this is separate to the deemed dividend, flowed to the company under our streaming provisions and really decision in Bamford, the deemed dividend was deemed to flow to the company and it was taxed in the company. Because it had a franking credit, or had franking, was fully franked, there was no end tax on that deemed dividend because we could apply the franking credit to it. It would have been taxed on the $300,000 of other income, but that's neither here nor there in the scheme of things. So what we had at the end of the day was we had no additional tax on our deemed dividend. We had our cash or our share buyback amount now sitting as capital of the trust, and we could take that out of the trust as a capital distribution to beneficiaries. So as I said, it's a very clever and it works within the share buyback provisions and income provisions to allow us to, in essence, access 10 million less the amount for the franking amount tax-free out of our company. Unfortunately, the ATO very successfully applied or decided and applied that Section 100A applied. So to recap on what our requirements were, we need to have a reimbursement agreement where we have a beneficiary made presently entitled to income, where there is an arrangement that the benefit of that will flow to somebody else, whether that's the trustee or another beneficiary, and there's a purpose of tax avoidance. So in this scenario, I would think it a classic case where, okay, you're technically within the other legislation and it's nice and neat and smart. However, you have got a really Section 100A risk, because at the end of the day, what sort of arguments can you raise to say that you weren't doing this for a tax avoidance purpose and there wasn't a reimbursement agreement? When you flow through the steps, there's no other, you could try to run an asset protection argument, but I don't think that's going to get you very far in terms of 100A. I mentioned it is under appeal, so we'll wait and see. I wouldn't be particularly hopeful, but you never know what the courts do. Or always depends on the court on the day. We've also had the decision in relation to Guardian handed down by the full federal court. So this was an appeal from the federal court. We discussed it during the year a couple of times, but in case you missed it, there was two aspects to Guardian. There was Section 100A, for a number of years, or for a number of years being applied, and then in the alternative there was a Part 4A being applied for a number of years. Again, Guardian, if you look through the facts, in my view, again, it's quite a good, clever arrangement, which ends up with a person who was a non-resident at the time receiving a dividend without further tax. So I can understand why the Commissioner is not happy with it in terms of continuing to pursue it. And I can understand why they tried to apply Section 100A and Part 4A in relation to it. On the appeal, originally it was for more years than the 12 and the 13 year in terms of the years that were under review. On the appeal, the Commissioner only concentrated on the 2013 year in relation to Section 100A. And for Part 4A, they concentrated on the 2012 and 2013 year. So in essence, what you had for Guardian was a distribution from a trust to a corporate beneficiary, which then declared a dividend to its shareholder, which was a trust, and that trust distributed to a non-resident. Dividend was fully franked, no further tax. On the facts in the federal court decision, the judge was satisfied in that case that this was not. There was two aspects. The judge decided that for one of the years, being the 2012 year, there couldn't be a reimbursement agreement. That was the first year that they did it. So you couldn't say that the dividend that was declared in a later year to, in essence, deal with the UPE and get the funds to the non-resident was a reimbursement agreement, because you couldn't say that would happen. For the 2013 year, the original judge in the federal court said it was ordinary commercial or family dealing. And that was based on the evidence of the parties involved, the accountant involved, the client, that it was overall, this was part of their plan to simplify things and wind down the structures as part of a retirement plan, with a mind to asset protection, because the client had been involved in some businesses that he sold and was concerned about some comeback if those businesses failed in terms of warranties or indemnities, and also in relation to his perceived shortcomings of his children in managing his affairs. So what was decided in the full federal court was, okay, Section 100A, as I said, the Commissioner only appealed 100A in relation to 2013. They actually decided that even though the judge had decided there was an agreement, a reimbursement agreement in 13, they actually decided in the full federal court that there wasn't, that at the time of the distribution, there was no agreement in existence. So 100A couldn't apply. So for that reason, they didn't have to consider whether ordinary commercial or family dealing was the arrangement was covered by ordinary commercial or family dealing, because they pulled it up there and they didn't make any comment on that. So we've got no further comment really, when you think about it, apart from the comments of Justice Logan in the original decision to say that this sort of thing was ordinary family and commercial dealing. So the tax office isn't going to like that. A little bit hamstrung, I think, in terms of what they do moving forward, but we'll wait and see. In respect of Part 4A, the appeal was allowed in part. So in the 12-year on the facts, the full federal court decided that there was no dominant purpose of obtaining a tax benefit. In the 13-year, they decided there was the dominant purpose was to obtain a tax benefit in relation to the schemes in each of the year. So it's kind of it leaves us with an interesting position where in the 13-year, when we look at it through a 100A lens, there wasn't even an agreement in existence under the legislation, which you need the agreement at the time of making the beneficiary presently entitled. But in relation to Part 4A, there was a scheme and the dominant purpose was obtaining a tax benefit, even though we had an earlier decision which hasn't been disturbed to say that what they did in 2013 for 100A was ordinary family or commercial dealing. So won't change the Part 4A outcome, but it's an interesting sort of contrast there. So as I said, I haven't checked recently to see whether that's potentially going to the High Court, but we shall wait and see. But either way, In terms of guardian and B blood, I would think that's going to change the Commissioner's interpretation in terms of the ruling. We're going to start our first poll now, and I think Kate's going to start it for us, hopefully. And we're just going to have a break to give everyone a chance to put an answer in, only for 30 seconds or so. And the poll is, will you consider Section 100A when giving advice to clients? So when you're talking to your clients, will you consider Section 100A? And as I said, we'll just give 30 seconds or so for people to put an answer in. At the moment, it looks, not sure whether people can see the results on their screen. I certainly can. At the moment, it's pretty high that everyone, well, not everyone, I should say, that the majority, if we look at the answer of yes or maybe, depends on structure, the majority of people are going to turn their minds to 100A and giving advice to clients, which, I mean, in reality, everyone should have always been, but it's one of those things that a lot of people didn't think about prior to the tax office talking about a lot. So that's finished off, 67% yes, 31% maybe, depends on structure. So that leaves us with 98% and 1% no. So thanks for your answers on that.
Sorry, Adrian, just before you move to the next topic, I've just got a couple of questions on 100A.
Yep.
And so the first question comes from Liam Dunn, and Liam's question is, in light of the recent finalised rulings, are you still of the view that a grandparent can fund their grandchild's private school education from their UPE being an ordinary family dealing?
Yeah, I'd still take that view. It's, there's a rationale behind it. It's something that happens whether it's from a trust distribution or otherwise. So I think as long as it matches what you say you're going to do, and that you're not just doing it and then money's not actually going into the school from the grandparents, I don't have an issue with that sort of arrangement in the perspective of Section 100A.
Right, thank you. The next question comes from David. And the question is, after the Guardian full federal court decision, is a simple distribution from a discretionary trust to a bucket company to limit tax to the corporate rate now potentially subject to Part 4A?
Yes. Anything you do is potentially subject to Part 4A. But you've got to see what is the dominant purpose traditionally. And I know I'm talking to accountants here, so most people will say we use a corporate beneficiary to keep our tax rate at 30% or whatever the percentage rate's going to be. But in reality, the counter argument is always we're doing that to build wealth in the family, or we're doing it so we can retain working capital in the trust. So that's your other reasons for doing it. Previously, when asked in forums, the tax office or tax office representatives have always taken the view, in my experience, that they wouldn't consider Part 4A in relation to vanilla arrangements involving corporate beneficiaries. In terms of that, and from memory, there was also in the National Tax Liaison Group, there was some commentary on that in one of the years as well, to say that they wouldn't do it. So, as I said, Part 4A could potentially apply to anything. Negative gearing a house, why are you doing that? If you ask anyone on the street, they'll say we're doing it because we want to reduce our income. But the reality is they're doing it to grow wealth, and that's the dominant purpose.
Thanks, Adrian. We've just had one more come through from Mark. Is building wealth always the answer for Division 7A, i.e. less tax, more wealth?
I wouldn't say it's as simple as, and I'm obviously cutting it short and saying we're just talking about building wealth, but without getting too touchy-feely, what's the general objective of most people? It's to build up significant assets to put themselves into a position where their children are better off than them. So whether that's being able to pay for more education, or whether that's building up those assets to give them a hand and help them into the property market, or to leave things behind for them. So that's what I consider when I use the phrase building wealth. It's really for that family group. And if we're doing this for that, that's our dominant purpose. We want to make sure that we're building up something that we can leave behind for our children and we can help them during their lifetime, then the reality is we want to pay the least tax that we can. So that's a side effect of that, so to speak.
Thanks, Adrian. That's it for now on that topic.
Okay, thanks, Kate. Anything happening with Division 7A? No. This could be a very short presentation. The legislative change, following the Border Tax Review, Border Tax Review would probably be over 10 years ago now. It's not going to happen anytime soon. From what I hear from Treasury, it's really not on the agenda. So we haven't seen anything in terms of changes to Division 7A. What we have seen is obviously the Commissioner gets sick of waiting, and they've finalised taxation, what was a draft taxation determination, but they've finalised TD 2022-11, which is the new interpretation of when there is financial accommodation. So in essence, what it means is that if you have ever used a 7-year or a 10-year subtrust with clients, that won't be an option now after the last financial year. And most people will either really just put it on a Division 7A loan, I would think, in order to comply. But the idea of having a 7 or a 10-year or some other version of a subtrust is no longer available under the finalisation. And I think there's a few reasons for that commercially that the Commissioner has done that. I think mainly, obviously, it was getting a bit unworkable in terms of having, each year having to say, at the end of the 7 years, you can then put it at the end of the subtrust life, will allow you to then put it on a 7-year loan. So with that, that's off the table now. The only real thing to touch on, and I won't go through the dates, but there is still a timing advantage in terms of our resolution, if we're giving a discrete amount or a percentage. So there is, in essence, sorry, I'll go back to the first slide. You get an extra year if you don't make it a discrete amount. And I would think it very rare that you're giving a discrete amount to a company, but the rationale behind that is that you don't actually get to financially accommodate until you can work out what that amount is. So if you say, I give $100 to the corporate beneficiary, you know what that amount is, that brings forward the requirement to comply. If you don't, you still get that timing advantage there, which, is kicking the can down the road in terms of those Division 7A payments, but tax minimisation is often about deferral. So that's extracted from the ATO material, and as I said, just gives you a bit of a timing advantage there. In terms of a next topic to touch on in 23, and this is, we're discussing this because it comes up a lot more when talking to clients about new business structures. And is really a function of our new, well, not new, but the small business tax rate now coming down to 25%. And the question being, and also, of course, the material that we've seen in relation to Division 7A and in relation to Section 100A of trying to get away from those UPE issues is often another rationale that I see mentioned in terms of not going down the trust road. So if we think about company or trust, and I won't talk about other forms of business structures because they're the two most often ones that we talk about. 25% tax rate, no UPE issues, no Section 100A issues, of course, no access to the discount capital gain. Trust structure, obviously we need to deal with UPEs, Section 100A, but we have access to the discount capital gain, a little bit more flexibility in terms of how we access funds, but no 25% tax rate on the trust income. So I do find myself talking more to clients about these things and about the positives and the negatives, and no doubt you do, unless you've just taken a blanket approach of saying all companies or all trusts, no matter what. But I do think that you need to go through the different issues with the clients. Of course, you don't have to get into UPE issues in 100A in great depth, and that should say no Section 100A issues rather than no Section 100 issues on the slide. But they do need to know the difference between the two, because as a 25% tax rate may sound appealing and you're saving 5%, for example, potentially, or more, if we've got something that's going to have a rapid growth in capital gain, in capital growth, then the access to the no access to discount capital gain is going to hurt us. And the fact that it's going to be in a company as well, the funds at the end of the day, is also going to hurt us. So it is a case, I think, of having those discussions with the clients, giving them guidance in relation to that. So I would, traditionally, Cleary Hore has been a big believer in trusts for both tax reasons and asset protection reasons, as the most appropriate business structure in a lot of cases. Safe to say you can't just say that these days, and you've got to work through these issues with clients. So with that, we'll move to our next poll, which is what structures for new businesses do you routinely recommend? So that's started that poll. We've got trust, company, other, depends on circumstances. So we'll let that run for 15 or 20 seconds. I think we're seeing the results of that being that, like most things in life, depends on the circumstances. And the reality, obviously, then is we've got to talk to clients more about it. And we've got to make sure we're discussing these things with them, which is not a bad idea. So certainly lets you get to know the client better and the structure better, and they get to see your expertise a bit more. So yeah, we'll move on from that poll. Trustee resolution issues. So very a brief description of the Owies case. So it's Owies and Owies against JJE Nominees Proprietary Limited. So the quickest way I can explain this one is that we had a discretionary trust which was established by the parents. They had 3 children, 2 sons and a daughter. One daughter and one of the sons were estranged from the parents, and the other son was not estranged, still involved. The parents traditionally and in a template format gave the money to mum, dad, and son, the favoured son, most often in a 40-40-20 split. Mum died during the years in question, and also in 1 year they gave everything to dad, or the trustee gave everything to dad. So the challenge in this one, or the challenge by the estranged daughter and son, I should mention 1 year the daughter was distributed a property out of the trust in one of the years in question. So, but the challenge was that they were beneficiaries and they hadn't been properly considered by the trustee, or the circumstances hadn't been properly considered in making those trust distributions over the years. They were default beneficiaries, and I guess that's a key point as well. The children, all 3 of them, were default beneficiaries. Just so everyone's on the same level in terms of default beneficiaries, if the trustee didn't distribute income or capital at the end of the trust, didn't distribute income during the year, then they received it as the default beneficiaries. So what the court decided in this matter for most of the years, that they weren't properly considered because the trustee had not made any inquiries as to their circumstances. So they weren't properly considered. They didn't talk to the other son for many years. With that, it was decided that the trustee had breached their duties in that respect, in not properly considering the beneficiaries. Does it cause great issues for trusts? Certainly, if you've got default beneficiaries, it could, and particularly where you're favouring some beneficiaries over the other. But it's a real reminder that simply doing the same thing every year in terms of sort of template resolutions may not be sufficient if we're doing it in a way that could expose the trust to challenge down the track, which leads us on to really, when we're drafting our resolutions for this year, I guess what we've discussed already, do I need to protect against Section 100A? So do I need to start building that evidence file of other documents or other agreements in relation to why we're doing the things that we're doing, apart from just lowering tax, to give us that sort of protection against 100A? And it's certainly, I think, in very helpfully in the material released by the tax office, they say that you should keep those documentary evidence so that if they do review you, they can quickly review and move on. So a little bit more work for everybody in terms of resolutions. If we do have default deeds, think about Owie's case, particularly where we're favouring some beneficiaries over the others and you're aware that there are issues amongst the family. You probably want to turn your mind to that and making sure that you're covering off that issue of, have we considered those other beneficiaries? Or have we made notes of what we've considered in relation to them? And of course, getting our usual streaming issues right. So streaming capital gains, franked dividends, making sure that we're stepping through. In terms of resolutions, I'm not sure how you prepare them, and our next poll is going to be on that when we run it. But clearly, the days of just having a very simple 2 or 3 lines or a couple of paragraphs are over, if we're going to be properly considering all of these sorts of areas in the resolutions. Which does move us on to the next poll, Kate, if you could run that one. Just curiosity about how people are doing resolutions. So how do you draft resolutions? Is it from scratch each time, using what we did from the client from last year? So what I mean by that is that you're taking whatever the resolution was last year and you tinker with it a little bit, using a new template each year from a provider perhaps, or the clients do them. So I'll let that run for 10 seconds or so. And unsurprisingly, it looks like the majority of people are using what they did for the clients last year as their template, and no doubt tinkering with them a little bit. So that's not unexpected. Just bear in mind, and you'll know your clients better than me, that if we're in that sort of Owie situation, and of course not all clients are, that we may be getting down the road of getting into a little bit of trouble down the track, or the trustee getting into a little bit of trouble down the track if we're just copying what we did from last year. And I think it also worthwhile, if we're doing that every now and again, you sit down and have a think about, well, was that the right thing to do last year? And having a think about those sorts of things when we're looking at them. I know everyone's busy and has time constraints, but obviously worthwhile just considering that every now and again. Bosnack, so an interesting asset protection case with twists and turns through its history. So we've had the final resolution in the High Court last year in 2022. So for those of you that weren't or haven't been to our earlier presentations, because we've discussed the federal court and then the full federal court decision in Bosnack, but the basic facts is that we had a husband and wife who, using joint funds, so funds that were within both of their names, they acquired a property in the wife's name many years ago. The husband subsequently hit some hurdles in terms of the tax office and was made bankrupt by a petition from the tax office. What the tax office, and in terms of that bankruptcy, they were outside any sort of bankruptcy clawback period in terms of the money that he had given to the wife, so to speak, to acquire the property. So what they tried to argue was that there was a resulting trust that existed in that the husband intended that the wife hold 50% of the property for him, because he was providing 50% of the funds, and therefore they could access 50% of the property. So in terms of the decisions at the federal court, initial decision, the judge said no resulting trust, and even if there was, the principle of advancement applies, which I'll come back to. Full federal court said there was a resulting trust and the tax office could have access to that 50%, and the High Court turned back really to the initial decision with some minor modifications. So with that, I mentioned the principle of advancement. It's a very old common law principle that says if a husband provides funds or provides an asset to his wife and the asset is in her name, that in the absence of evidence to the contrary, that's intended to be her asset solely. So it's the husband advancing the wife. It doesn't work the other way, in which you can probably tell how old it is. So with that, in terms of the decisions as it went through the court, one thing to remember is that by the time that this all came about, the husband and wife were divorced. Husband didn't give evidence. It was only the wife's evidence. So what the High Court effectively said was that there was no resulting trust. It wasn't the intention that the wife hold 50% of the property on trust for the husband. And really what the full federal court did was focus too much on the intention of the husband as opposed to the evidence and the intention of the wife. So they effectively said, you've done bad here, full federal court judges. You haven't really focused on the core issue, which is what are the facts about the acquisition of the property, and was there really evidence to show on either party that there was a trust there, that the wife was holding it on trust, which there wasn't in terms of the evidence. They didn't need to consider the principal advancement, but they did make some comments that they considered it to still be valid in Australia. As I said, it's an old English common law principle, so it's not in the legislation. It's just something that developed in England and we inherited under our English legal system. They said it's still valid. They didn't need to apply it in the circumstance, but they also made the comment that if people are, if that is to be changed, then that's a job for the legislature. It's a job for the government to change by putting in some legislation that changes that concept. So at the end of the day, a good decision from the perspective of asset protection, in that we don't have to have these crazy arguments about whether in somebody advancing some funds to somebody else, do they have a trust interest in that property, where we've got that husband and wife type scenario. So a good result at the end of the day for clients, as opposed to the tax office or any other creditor pursuing people. Last one we're going to cover is payroll, tax and medical centres and other businesses. So we've certainly seen, and if you read some of the cases, recognising not everyone reads cases, we've certainly seen a lot of action in this area from state revenues in the states that we operate, looking at what I kind of often conceptualise in my head as kind of like a hub and spoke model sort of thing, or a contractor model for businesses. So medical centres, optometrists, security businesses where they're engaging contractors. Had a case involving a model agency, electrical businesses. We're certainly seeing a lot of audit activity and a lot of action and a lot of court decisions in relation to those sorts of structures. I mentioned there's a new ruling issued by the Queensland State Revenue Office in relation to medical centres, issued on the 22nd of December, where effectively they take the position that payments made by the medical centres are caught for payroll tax purposes, unless there's an exclusion that applies in terms of some normal exclusions from contractor payments. So I saw, I think it was 2 days ago, there was an article published by the ABC quoting the medical body's dislike of this new ruling, and unsurprisingly suggesting that this will increase the cost of medical care if it's imposed. So that's been released in Queensland. The other states will follow. I know New South Wales have a similar draft ruling ready to go. However, the Nawaz case, which is a medical centre case involving payroll tax, is currently being under appeal and being decided. So the OSR have decided to wait until that's issued before they issue their ruling, in case there's a dramatic change in that appeal. So it is an area, if you've got clients with these sorts of businesses, as I said, what I call hub and spoke or contractor type businesses, they really need to review their affairs to see if they're going to have a potential payroll tax liability, and if not. I mentioned there on the slide, the next big issue going to be influencers. You may know, or may think that to be a bit of a joke, but certainly seeing a lot of activity and a lot of further concentration on that world, because the reality is, and to be honest, until we started working with some agencies and some other law firms that are involved in this area, the reality is it's a massive business, the influencer world, and unsurprisingly, not many people are complying with payroll tax, PAYG, super. So we're going to see a lot of activity in that world, I would think. So again, if you are do you have clients that do operate in that world? Again, need to revisit their affairs. Just very simply, in terms of PAYG and super, if you're unaware, there is in effect an exclusion to the normal contractor provisions for PAYG and super, where you are deemed to be a performing artist, and influencers would definitely fall within that definition. So something that many of them are not aware of, but certainly should be aware of. Okay, and then end our presentation. We've just got 2 more polls to run while Kate is fielding any questions. So if you've got any questions on what we've covered today, chuck them in. Kate, I might run the polls if that's all right. If you want to curate any questions that do come in while they're running.
Yeah, sure, no problem.
So the first one, our next webinar will be in roughly 4 weeks' time. We were talking this morning, Kate, Kimberly and I, as to who would present, and neither of them really wanted to volunteer. So we thought we'd leave it open to the audience as to whether they would like to see Kate present in February. It may actually be the beginning of March, or whether they would like to see Kimberly Barnes, who's also presented. So hopefully no one gets their feelings hurt in relation to either being voted in or not voted in. We'll let that run for 10 or so seconds, and hopefully it doesn't end up 50-50, because that puts me back in a position of having to make a decision. And I think you're up, Kate. Looks like you've got the benefit of perhaps being on screen. And
Oh, we can give it a bit more time.
I'm not sure it's going to change that much. All right, well, that's settled. Kate, you're up presenting.
All right.
Next month. And the other one that we have, I was talking to an LRC member during the week who was tuning in today, mentioned that Friday, which we often run webinars on, is not really a good day for him, and got me to think that in our new world these days that people generally take Mondays or Fridays off if they're doing short weeks. So our next poll that we just put up there is, so what day works best for you for a webinar? This is just a curiosity thing to see where people sit with that as to what day they would like to do webinars. May mean we change them, may mean we don't change them. We'll just wait and see. But obviously, as Kate mentioned, we do try to take feedback on board, and one of those sorts of things is, what day to present and what topic to present. So try to keep you can't keep everyone happy, but try to do the best that we can in that regard. So it looks like a pretty strong showing there for Thursdays, maybe because today's Thursday and you're all here on a Thursday. But good to know, and yeah, thanks for your time in doing those last 2 webinars. Last 2 polls, and also the polls before. Right, Kate.
All right, I do have a few questions for you.
Yep.
Question from Katrina, going back to 100A. So we've got a trust which has distributed 160K across to an individual beneficiary, but it is a discounted capital gain. Would the trust need to distribute the accounting distribution of 320K? Where's the second part of the question? And if the trust does not distribute the full amount physically, could it be caught by 100A?
So to an individual, if they're the only beneficiary, then that's fine. Just doing what you've done there in terms of the actual making the distribution valid. If there are other beneficiaries that you're distributing it to so that you can stream the capital gain to that person, then you would need to also distribute an amount equal to the discounted gain as a capital distribution. So you do need to think about that. If it's a scenario where it's all going to one person, you don't have to worry about it because you're not streaming. In terms of 100A, leaving it unpaid, normal sorts of analysis. If it's going to an individual, even though you're paying the discount, you're going to be at individual tax rates. So there's no tax benefit there in terms of a reimbursement agreement, I wouldn't think.
All right, thank you. I've got a couple more. Going back to payroll tax and doctors, question from Henry is, those doctors are providing services to the public. In a nutshell, why do you think the OSR does not think they are providing services to the public in those cases where the OSR won?
Yeah. So it comes back down to the interpretation of the legislation and the definition of what the relevant contract is. Is the contract between them, or is the contract, or is the payment, the relevant payment, is that because of the contract that they have with the medical centre, or is that because they're providing services to the public? It's because of the payment is flowing under the contract between the medical centre and the doctor. That's why, and it fits within the legislation, and that's why people are getting caught out.
All right, thank you. Just touching on your point about influencers, question from Cole. When you mention influencers, are you talking about Instagram, YouTube, etc.? And for those types of peoples, how do they employ, or how are they employed?
So I am, and I must admit, I have no social media whatsoever. So I rely on my cool young staff to teach me all these things and trends. Generally what will happen, and of course it's usually a bit different, is if I have a product that I want to increase the sales on, so let's say I've got a line of swimwear that I sell, and I want to get more people buying it, and I don't do traditional advertising in the form of television ads or Facebook ads even, or newspapers, going really old. What I will do is I will either, most of the popular influencers, and yes, this is TikTok and YouTube and or YouTube Shorts and TikTok and Instagram. What I will do is I'll approach either them directly, or I will approach, usually they'll have an agency. So there are agencies that only really deal with influencers as their clients. And I will pay either in cash or in product them to promote my product on their social media. So that's how that operates. Whether it's cash or whether it's product, it's income to the influencer. As I said, in many cases, there will be an obligation to remit PAYG because they are deemed to be a performing artist under the legislation, even though they are a contractor to the business. They're not an employee under the traditional sense. But that's how it works in essence. Usually, it's via the agency, but sometimes people do it directly.
All right, thank you. I've got a couple more on doctors and payroll tax. So going by what you said earlier, does that mean that patients should pay the doctor as opposed to the practice receiving the income and then paying the doctors from there?
Yeah, well, unfortunately, the way they're sort of interpreting, you kind of usually get caught either way. But in essence, if you are just paying the doctor, and then the doctor is, paying for the use of an office, that shouldn't be caught. But bearing in mind that there are other factors at play, which you've seen in the optometry case and AWAS in terms of, since you're promoting the business. And the other aspect of that is commercially, from the medical practices perspective, they often want to lock the doctors in. So they want to be taking all the money in and making sure the doctors aren't working elsewhere and all of those sorts of things. So depends on the circumstances, but I don't think practically it works that everyone just pays the doctor themselves, because they don't want to handle the funds. They don't want to have somebody employed to really to run the machine and the high caps machine and those sorts of things. So I think unless there is a change, there's something that people are just really going to have to live with.
All right, I've got a couple of related questions, again, on medical practices and payroll tax. So if a doctor invoices the patient and the associated medical practice receives the payment and transfers 70% to the doctor and retains 30%, are these payments picked up under payroll tax as taxable wages?
So under the Queensland interpretation, if you have a look at that, they would say that, and I recognise the legislation in the states are slightly different, but very much the same. They would say that would be caught by payroll tax.
A new question from Joshua. If the doctor is operating through a proprietary limited company, will that potentially avoid payroll tax for the practice?
Would depend on what else they're doing within that company, but potentially it may not. a bit hard to say. But if it's a scenario where they only ever work at one practice and it's the one they're contracting through a company for whatever reason, it's probably not going to protect. It won't protect them, but it will depend on the circumstances.
Yeah. Okay. And then just one last question on payroll tax. Comes from Harry. With doctors, they provide services under their provider numbers, and the clinic only collects their fee in trust and deducts their part and pays the balance to the doctors. Why would the doctors be considered employees?
Yeah, it comes back again to the contract between the doctors and the medical practice. Quite often they will be styled as contractor or practitioner agreements sort of thing. So the contractor agreements. The way that it is being interpreted and applied at the moment is that the way I kind of think of it is, if what you're doing overall is promoting the business, so people are going to the medical centre, then it's going to be caught by payroll tax, and it's going to be a relevant contract, and it's going to be a payment pursuant to it. And you certainly saw that in the optometry case and NAWAS and those sorts of things. So, yeah, I do understand that it's their provider number, and in a pure sense, it's really just a service entity or a service trust, the medical centre. But it is more than that in practice. When you actually get into it, it is really, they are contractors to that business, and they're assisting in the growth of the business, really.
I think we'll just do one more question from Mark, just moving away from the payroll tax. So there's a single client who distributed $260K to their parents from a service trust. She has paid her income tax of $60,000, but she's questioning if she distributes the balance of $200K to her parents, could they then gift it back to her directly via cash or otherwise, such as purchasing a car for her?
Yes. Like with most things that, as I said, you need to consider 100A. Is there a reimbursement agreement in that scenario where you've distributed to the parents on the basis that they would then give it back to you or buy you a car? Technically, from what Guardian said, was in the first year that you do that, there can't be a reimbursement agreement because there has to be an agreement in place at the time that you make the distribution. So unless you're silly enough to say in your resolution, I'm distributing this to you on the basis that you will pay it back to me, which no one ever does, there can't be a reimbursement agreement technically in that first year. If you're doing it year after year in a pattern and there's no other explanation as to why you're doing it apart from lowering tax, then I think you have further concerns down the track. But as a one-off, technically, according to Guardian, there can't be a reimbursement agreement, as I said, unless it's clear that there is an arrangement that it would come back.
Thanks, Adrian. There have been a couple of last-minute questions which have come in, but given the time, I think we might just go back to those people separately.
We'll keep a record of those, and we'll go back to them.
All right. Well, thank you, everyone, for your attendance and your participation today. As I mentioned at the beginning of the webinar, there will be a feedback email circulated later today. And so could you please keep an eye out for that email? And if you have the time, complete that, particularly looking at what the webinar I'll be presenting in a few weeks might be on.
By the sounds of it, it might have to be payroll tax again, Kate.
Yeah, perhaps. And so, there will also be an email advertising that webinar, which will be in the week of the 27th of February. So again, if you could register for that one and hopefully attend, we look forward to seeing you there. But otherwise, thank you again and enjoy the rest of your day.
Thanks, everybody.